MSCI stock is not down by a lot since all-time high, but has been coming down in valuation over the past few years, since it's been trading sideways. This is another way that a stock can correct its valuation. If the company is growing over time and the stock price has been going sideways, underneath the company, the valuation has been dropping. So, not the most obvious way you can tell valuation has come down is obviously when the share price is plummeting, like it did here, going from 660, coming down almost 50%, more than 40%. So obviously the valuation is also going to come down. Whatever the valuation was when it was trading at its all-time high here, it's going to be 40% lower if the underlying fundamentals of the business doesn't change too much. So let's get into it. We're going to analyze this company, and we'll take a look at not just the price chart, but some other metrics, and you'll see what I'm talking about. Market cap, this one is sitting at 42 billion. P ratio 36, 4P 30. So this is already a good sign. Not hyper growth here in the earnings department, but solid growth. We just need to make sure that this is going to be consistent. This is going to continue to happen. And we're just going to make money by holding this company and being invested in it over time. It does pay a dividend, 1.3%. This is also good to know. It's a bit more attractive to buy and hold over the long term if it does pay a dividend. I do not go for dividends necessarily, but it's also it's always a sweet, juicy bonus just to hold while the shares appreciate in price. Let's take a look at the revenue. 10 years ago, it was doing a little bit more than $1 billion. Now it's at $3 billion. So not hyper growth, but very solid growth. It's still growing at double digits. And it's very consistent. Yeah, some years it might have had 20%. This is 2020, 21. All of the companies, pretty much all of them, like 95% of them have had an increase of revenue. I'm talking about the S&P 500 here. And then they had a crash, of course, when people stopped receiving free money from the government, and yeah, they had a slowdown. But this MSCI stock is fairly consistent. It's still growing at a 10% per annum, and it was doing 10 years ago about 10%, even lower. So not much has changed. This is on the same trajectory it's been since 10 years ago. So that's great. That's predictability. That's consistency. This is exactly what we want to see. Let's take a look at some other stuff. Net income. They were doing 200 million 10 years ago, and now it's more than 4 times, let's say $1.2 billion in net income. Shares change. Let's see. So this looks like a very mature company. They have been retracting shares for a long time, at least on this graph for the past 10 years. They, especially in this year, 2015, 2016, they have retracted a lot. What's the percentage here? 12%, 6% in 2015, and then 12% more. Yeah, that's a lot. So that's just to keep in mind. This company can go crazy with buybacks if it has the possibility and the cash to do it, but probably you're not gonna see this happening again because the company now is at a much higher market cap compared to their net income, so they can do some less buybacks. They have less buyback power for sure. Let's see here. The percentages last 5 years hovering around 1% when the stock was at all-time high, and then when it crashed, the yield improved, the percentage improved, and yeah, trailing 12 months 1.7%. It's not gonna offer us a crazy amount of it's not gonna fuel share price increase, but it helps that this company pays a dividend and is a habitual buybacker of shares. We have to take that into account. Cash and cash equivalents, it had a all-time high cash pile of 1.5 billion 6 years ago. Now it's at an all-time low, not all-time low, but over the past 10 years, it's pretty much depleted, 300 million. So expect less buyback power, also less dividend yield increases as a percentage. Let's take a look at dividend increases. Dividend per share, dividend growth. Yeah, this has been growing their dividend a lot. 2021, 24%, 25%, 20%, 16, now 14. I mean, if this continues, let's say 12, 10, 8, I mean, that would be great for me if I buy and hold it right now. That 1%, it's quickly going to become 2% and then maybe some more. Depends on the price action. So, yeah, I'm happy to see that, but I want to take a look at the debt levels. I don't want them to go into debt in order to fuel these buybacks and the dividend increases. So let's take a look at long-term debt. It has been increasing. This is not necessarily a bad thing because the company has also increasing. But as you can see, it's been flatlining the long-term debt since 2022. They did not take on more debt, which is great to see because yeah, the treasury yields and the yields have been not been 0%. So before 2021, it was very sweet to borrow money. You had almost 0% yields on the cost to borrow. So after 2022, they stopped getting more into debt, and the company still is still growing, has grown quite a lot since then. So this is a green flag. Let's take a look at shareholder equity. Negative here. Generally, I want to see something that's positive, but something that has insane margins. I mean, I forgot to take a look at the margins. Let's take a look at the margins. I already know what they are, but let's just see here what we're dealing with, what type of company. Gross margins, 82% right now, all-time high basically. And 10 years ago, it was at 75. So improving and maintaining. Also, operating margin has been trending up 2015 to 2021, and then yeah, it's been hovering around more than 50%, which is kind of insane, to be honest. It's yeah, this is Nvidia levels of operating margins, and it's very consistent. I mean, Nvidia is not going to have this consistency. It's Nvidia has cyclicality to it. It's a semiconductor in the semiconductor industry, but this one has been improving and has been maintaining this very high level of operating margin, which is great for us if we want to buy and hold this for a long term. The problem with these type of companies is that you very rarely have opportunities to buy them and hold them. You had an opportunity 4 years ago, but I think today is not a terrible entry point. But yeah, profit margins, again, same story, improving and maintaining. Free cash flow margins, man, this is very nice to see. Extremely high. I don't think I've seen like maybe a few other companies. This is higher than my Adobe, which is at the top position that I own right now in my portfolio. But yeah, anyway, let's take a look at the balance sheet. So long-term debt, they haven't been increasing in debt levels. And when we took a look at these margins, when we know that the company is such a monster and has such a beast of margin levels, yeah, this is nothing basically compared to the market cap of 44 billion or whatever it was. Yeah, this debt is nothing. It's basically, you can consider it no debt. Net cash, they are negative, but they have been stabilizing, it seems. So yeah, it's sad to see that they don't have a bigger cash pile, but that's not going to shy me away from buying this company. Net income growing up, we already took a look, but we want to take a look at the numbers again because we're going to compare it to the stock-based compensation. So around 1.2 billion of net income, and then stock-based compensation of 100 million. So less than 10%. This is great to see for the margins that this company has and the super high quality that it is. Seeing a stock-based compensation ratio to the net income of less than 10%. This is my type of company that I want to buy and own for the long term. Repurchase of common stock. Let's see. On and off the buyback button. They have done a lot in 2022, 1.4 billion, and they have not doing much in 2021. So what does this mean? Well, let's take a look at the share price a bit. So 2021, it was at crazy all-time highs and very overvalued. And the management said, yeah, we're not going to be buying at these ridiculous levels. And this is exactly what I want to see. This management is very smart with the money that the company has, with the cash. They're not just going to blindly buy back shares at any type of valuation. And when the share price collapsed, they immediately intervened and they offered a very solid floor. That's why the bounce backs are very violent here. 31%. I'm pretty sure that's because of them buying back their shares and then collapsing again, and then maybe they bought back again. Yeah, this is great to see. The management buying back shares, accelerating buybacks when the share prices are low, when the valuation is low, and slowing down when the valuation is sky high. So this is exactly what I want to see when buying and holding in long-term company. This is a long-term buy for me. So yeah, as you can see here in the market cap, because of share buybacks, it's not that far off the all-time high price. But the share price is also not very far from all-time high. We want to take a look at the valuation ratios right now. PE ratio 36. It was at a high of 70, so it slashed about half of its since all-time high when it was in the bubble. And I would say it returned to normal levels. It's not prohibitive for me to enter at this price point, but there are other companies in this industry that are trading a bit higher, and I will show you right in a moment once we finish with the valuation on this page here. Forward price to earnings 30, not all-time low, not in the low of this chart, but still 30 compared to 25, 29, 24. It's not that far off the lows. Can it drop some more? I would say yes, but the share price, I don't think it's going to fall necessarily. I think it can improve their earnings without the share price falling. So just by them buying back shares or just the company improving in profitability. Price to book, I don't know what's going on there. Price to sales 14 for this high margin company. 14. I don't think it's extreme, but it is high. But it's a different type of company. It's not like a retailer or something like that. Not even software. EV to sales 15, not at an all-time low. EV to EBITDA 27 times. Used to trade at 15 10 years ago, which was kind of crazy, but it did have a high of 45. So yeah, we have a decent margin of safety when buying it right now. ROIC, let's see here, trending up over time. Management is doing great things. They become more efficient. They have higher and higher returns on the money that they have invested with the company. So 10 years ago, it was 10%. Now it's at 26%, trending higher and staying there. Yeah, I love to see this. ROCE 15% 10 years ago. Now it's at 41%. Again, great looking graph. Amazing. Two amazing green flags, and we will compare in a moment to other companies in this industry. FCF yield 3.4%. We are getting it cheaper than the 2.8% that the S&P 500 has right now. So a company that's basically twice as good as the S&P 500 average, but we're getting it cheaper. So I think that's pretty nice. Dividend yield 1.3%, and the payout ratio is around 47. I think, yeah, it can still grow at more than double digits for quite a number of years before they have to slow down the growth. Total shareholder return, as you can see here, right now it's at 3%. Yeah, amazing. These few years, you were getting paid a dividend and also getting a crazy amount of buybacks. I mean, this was quite wild to see. I mean, yeah. Yeah, let's take a look here now at some competitors. So SPGI, Intercontinental Exchange, CME Group, Moody's Corporation, the Nasdaq, and our MSCI, and then we have Broadridge. But as you can see, for the other we're not going to take a look at the other companies, but because the margins are vastly different. So SPGI gross margin 69%, our MSCI is 82%. So 53%, 54, let's say operating margin. CME Group is much higher here, but yeah, as you can see, it's very solid. It's up there, number 2, I guess, in margins department. CME Group is higher in all aspects, but it's a much more mature company, and here the 4% represents compounded annual growth rate in the revenue. So 4% compared to our 13%. Yeah, let's just take a look for MSCI revenue. yeah, it's a lot slower growth than our MSCI pick, as you can see here. So it does have higher margins, and this is something that I expect to see from MSCI as well, even improving in margins, even though they're extremely high right now. But until the growth settles and it's going to come down, the margins, I'm hoping that they improve, because the management, from what I see, has been doing great. SPGI here, so let's just say revenue 5-year growth, 15% is not far off from our 13%. But if we take a look at valuation, you're going to see that MSCI is trading at a lower multiple and a much more attractive price. 17% net income over the past 5 years compared to 9. 13% for the Nasdaq. And then we have ROIC and ROC, return on capital employed. So ROIC 5 years, and ROC not 5 years, just the last year, because the website that we used does not have the last 5 years average. So 21% last 5-year average, and ROIC much higher than a bunch of these companies. And higher than SPGI and Moody's Corporation. And then ROC, by far the winner here. Only Moody's Corporation is coming close with 24%. But yeah, SPGI 11%. I would not want to own this right now at the multiple that it's trading, which is a P ratio 42. But if we take a look at the ratios, for a P all-time high, it seems like P ratio close to all-time high. FCF yield 3.2%. So a little bit lower than MSCI, but yeah, the numbers are just not the same. I mean, they had a massive drop here. They used to trade around 30%. I think they did some merger and acquisition, and yeah, their invested capital returns have been plummeting, have plummeted all of a sudden. Yeah, so let's see here. MSCI, 3% shareholder yield. So buybacks combined with dividend yield, kind of in line with other top high quality companies, except Intercontinental Exchange doesn't have any yield at all. So yeah, I think it's a much more attractive buy, MSCI right now. We take a look at the price action over the past 5 years. It's up 54% compared to the 58 of SPGI, and then 82% of Moody's Corporation. Let's put in some CME Group, Intercontinental Exchange, and see. I don't know if you can see, but in the dark blue here, we are lagging a little bit. So just a little bit behind. Make no mistake, I am very glad to own all of these companies. Hopefully I will have owned at some point in time each one of these companies, because they're all great. But right now, where am I gonna deploy my money? I cannot just buy them all, because I'm gonna diminish my return. Okay, I have to make a decision which one is cheaper and which one is just going to offer me the highest return over the next 2, 3, 4, 5 years. Because as you can see here, the margins are quite different for each of them. The growth rate, revenue growth rate is different for each of them. So 4% is going to be a lot different than 10%, a lot different than 13%, a lot different than 15%. Also 17% in net income growth over the past 5 years is a lot different than 7% or 4%. So you have to take everything into account and make a decision. I came to the conclusion that I want to own MSCI right now, and it's going to be, I'm going to do some changes. I'm going to sell my Paycom stock here. Let's see. I have it as a top position of mine, and I'm going to make a video about it soon. So Paycom Corporation is sitting around 4%, and MSCI is around 2.8%. And I just think I'm going to have a bit higher growth over the next 3 to 4 years with MSCI compared to Paycom. And I just want to also take some profits and reduce my exposure and risk to a recession. Paycom is going to be very sensitive to a recession. So I'm just going to be selling a bit of Paycom and buying MSCI. And I'm not going to pour everything that I sell from Paycom into MSCI. I'm going to buy some more stocks, because I want to have some more stocks in my portfolio, also to make a content with, but also to mitigate my risk level, because I used to have Intel as my top position, and it created a lot of risk and drawdowns. As you can see here, risk score, average risk of 5 in April. Then Intel became my top position, and I had a risk score of 6. I do not want this for my future copiers. I want very good outperformance to the S&P 500, and I want as low risk as possible. I don't want people to panic. Even though I myself can stomach swings and I have consistent income, I want people who copy me on this side to have much lower risk. So it's already come down to a risk of 4, and I'm not looking to change anything right now, just to change the risk. It's good enough for me. Risk score of 4, I don't even know what it means. I think drawdown less than 5%. So yeah, risk score a 4. Actually, it's 2.7%. So I had the risk score of 6, which was more than 5%. So yeah, that's my portfolio volatility has come down by 50%. So that's great. And my returns, I don't think they're gonna come down by 50%. I'm still gonna make a lot higher returns, regardless if I have Intel as my top position or not. But yeah. Anyway, that was it. So that's the end of the video.